Good morning, good afternoon, good evening, everybody. I want to, on behalf of the Financial Management Association International, welcome you to the very first seminar of the fall semester of the Research Seminars in Finance, Economics, and Banking, co-hosted by FMA and FEBRN, which is a coalition of various universities across the world. To kick off our fall semester, we have a spectacular researcher and also good friend of the association, Professor John Campbell of Harvard University. So without any further ado, I'm going to go ahead and pass it over to my good friend Cesario Mateus, who will introduce our speaker today.
Thank you very much, Michelle. At FEBRN, we are excited to start this new season of the Research Seminars in Finance, Economics, and Banking. And as you said, Michelle, is a long-term partnership with the FMA International. It is my pleasure to introduce our speaker today, Professor John Campbell. Professor Campbell is the Morton and Carol Olshman Professor of Economics at Harvard University, where he has taught for more than 30 years. He has published over 100 articles on various aspects of finance, macroeconomics, including fixed income securities, equity valuation, portfolio choice, and household finance, which bring us today. He published several books, including Fixed, Why Personal Finance is Broken and How to Make It Work for Everyone. In this book is the outcome of decades of serious academic research on personal finance, an area which requires significant reform and restructuring. He served as the president of the American Finance Association, and he is a research associated and former director of the program in asset pricing at the National Bureau of Economic Research. He is a fellow of the Economic Society and the American Academy of Arts and Science, a corresponding fellow of the British Academy and honorary fellow of Corpus Christi College, Oxford, and holds honorary doctorates from BI Norwegian Business School, the University of Maastricht, the University of Paris Dauphine, and Copenhagen Business School. Professor Campbell also co-founded and serves on the board of Arrow Street Capital, a Boston-based quantitative asset management company. Well, without further ado, Professor Campbell, on behalf of FEBRN, FMA International, and our worldwide attendees, thank you very much for accepting our invitation, and we are looking forward to your presentation.
Well, thank you very much, Michelle and Cesario, for that kind introduction, and welcome. I'm delighted to talk today about my book, which is forthcoming next month. It's published in October. Fixed, Why Personal Finance is Broken and How to Make It Work for Everyone. The book is a joint piece with Tarun Ramadarai from Imperial College London, who is a former student of mine, a frequent co-author, and a very good friend. And I've really enjoyed working on this book with him. So, here's a picture of the cover, and as the title suggests, this is a book for a general audience. This is not an academic monograph. This is the first time I've ever tried to write a book for a general audience, and I'm curious to see whether I've succeeded. But there's no math. There's not even any tables of numbers in this book, only a few figures and plain English. Because it's a non-academic book, the endnotes are important, actually, because they are what provide the links to the academic literature that we're drawing upon in this book. So I think for people listening to this seminar, if you do read the book, you'll find the endnotes are actually an important part of the experience. But for the general reader, I'm sure they won't look at those. So what is this what's this odd title? What do we mean by fixed? So fixed is intended as a pun. It refers both to the current state of the financial system, which is fixed in the sense of rigged. It benefits financially sophisticated people at the expense of the unsophisticated. And that honestly means normally benefiting richer people at the expense of poorer people. But then the second meaning of fixed is that we can fix this in the same way that we might fix a machine. We can repair it. Now, because of this focus on the system, the book is not written as a self-help guide. We're not trying to compete with a book like Personal Finance for Dummies or any of the works of financial influencers. We think that readers will get a lot of useful advice along the way, but that's really not the purpose of the book. The book is focused on the financial system and how we can reform it. I'd also like to emphasize that we have a global perspective. Self-help books have to be very local because different countries have different details of their financial systems. And so the terminology differs, the tax code differs, and so on. But one of the themes of the book is that there are common problems around the world and that we can learn a lot from comparing the experiences of different countries. So hopefully that'll become clear as I go through. So what I thought I'd do is rather quickly take you through the book, flying over it in a helicopter, if you like, just to give you an idea of what's in there. And then hopefully we'll have some time at the end for a general Q&A and discussion. So the book has three broad parts. Part one is an overview of the problem. What are we talking about? What is this fixed financial system in broad outline? Part two gets into specifics, what actually goes wrong in detail in personal finance and what's the evidence on that. And then part three is our proposed solution, how we should try to fix personal finance. So what's in part one? There are three chapters. The first introductory chapter describes the scale of the problem. The second chapter talks about why personal finance is so difficult for people. This is really drawing on the behavioral finance literature, all the work on cognitive biases, present bias, and all those sorts of things. And then chapter three is a critically important chapter. I think if I had to pick one chapter to get people to read, it would be this one, because chapter three is talking about how the biases that people have and the mistakes they make actually corrupt the functioning of capitalism and turn it into a dysfunctional system that often exploits people's biases rather than correcting them. So let me go into a few more details then on these chapters. What's the scale of the problem? We start the book actually with some anecdotes about individual people because we want readers to really relate to all this. I'm going to skip that for this more academic seminar and tell you about the bigger themes of the chapter, which really are that the personal finance system is faced today with increasing demands. People have to use personal finance products more. They have to make more personal finance decisions than was ever the case in the old days. And there's a number of reasons for that. One is people are living longer and they're living in smaller families. So when you reach old age, you're not going to be living with your children or grandchildren necessarily and being looked after the way you might have done in a traditional rural society. So you have to finance your retirement. Secondly, education is more and more important, and higher education is very expensive in many countries. This will depend, of course, on the country we're talking about. Some continental European countries still provide essentially free higher education, but many countries don't. And actually in emerging countries, even secondary education can be expensive. So people have to finance that. Then, of course, there's a massive global trend towards urbanization. And urbanization tends to mean that housing is more expensive and is a bigger piece of people's budgets. But if people are going to own housing, then they have to finance that. And perhaps the biggest trend of all that we want to highlight is the growth of the global middle class. So the figure on the right is one that's in this chapter, although I will say the book's in black and white, not color. But the two distributions shown, the one at the top is the global distribution of daily income per capita in 1975, and the one at the bottom is the same distribution in 2015. And what you see is that in 1975, that there was a two-hump distribution. You had a big middle class in developed countries at the right, and an enormous number of very poor people, primarily in Asia, which is the red region, over at the left. And all those people at the left were not involved with personal finance products. Fast forward to 2015 and look at the lower figure, and we now have an enormous new middle class, particularly in Asia, but also in other regions of the world, that is now wealthy enough to use personal finance products. They may not be wealthy by the standards of the middle class in developed countries, but personal finance is relevant for a huge number of people. So big problem and a global problem. So that's the message of this chapter. We also emphasize that personal finance contributes to inequality of wealth, which is a huge contemporary concern. Whether you think of Thomas Piketty's work or there's a vast literature on inequality. And we emphasize that personal finance can contribute to that because through several channels. Richer people earn higher returns, they borrow more cheaply, and they also save more. Now, the return differences are illustrated on the right here in a figure which is taken from a paper by Bach, Calvé, and Sudini from 2020 AER that looks at Swedish data. And they measure the rates of return on assets, that's the red dashed line in this figure, which is plotted against your position in the wealth distribution with poor people at the left and rich people at the right. And you can see how the rate of return on assets increases steadily with the level of wealth. Rich people also borrow more cheaply. The gray line shows the debt cost relative to the risk-free interest rate, and you see how that generally slopes down. And then if you put the two together and compute the excess return on net wealth, which is the blue dashed line, you can see that rises steeply. The poorest people basically on their net wealth earn the riskless interest rate. They have an excess return of 0. And the richest people have an excess return on average of about 8%. So just a massive difference. Now, the reasons for all of this are both fundamental and behavioral. I mean, there are, of course, fixed costs of providing financial services. So inevitably, the proportional costs will be higher for poorer people with smaller accounts. It's also true that rich people have collateral. They have houses, for example, against which they can borrow more cheaply. But in addition, poorer people are more prone to make financial mistakes. And, for example, not participating in risky markets, not shopping around, not refinancing their mortgages, and so forth. And so the book is really about that last aspect of the problem. Okay, so then chapter 2 goes on to talk about why people find it so hard to do the right thing in personal finance. And we start by reminding readers that financial illiteracy is very widespread. I illustrate this with the charts to the right, which it's an update of charts that I included in my Ely lecture to the AEA about 10 years ago. And basically, I'm summarizing results from a US survey in 2021, the National Financial Capability Study. And these are test results from a very simple little financial literacy test. And we define low financial literacy or illiteracy as a score that is equal to or less than what you could get by guessing randomly. And the height of the bars here shows how many people are illiterate in that sense. It's over half people on average. The left of the figures are younger people, so illiteracy or low literacy is more common among younger people. It does go down with age. Low financial literacy is worse for women. The women are the red bars at the bottom, and the men are the blue bars at the top. But in addition, what the dark pieces of the bars show is the which of these financially illiterate people are highly self-confident about their own abilities? And as you see, many people are. And it's remarkable that particularly among older men, there are fewer financially illiterate older men, but those who are extremely confident. They almost all think that they know what they're doing. So this phenomenon of overconfidence about your own financial ability is a serious problem. Now, you might react by saying, well, let's do more financial education. And, this is something I'm involved in. Later today, I'm going to teach a personal finance course at Harvard for undergraduates. But we don't think this is an adequate solution by itself. High school financial education is great. It's spreading in the US. But the problem is it's a little bit early in life for most students. Imagine that driver's education was just in the classroom and not on the road. How much would anybody remember about how to drive? It's sort of the equivalent of that. And good financial education really requires some math expertise to teach, but math teachers are very scarce in schools. College financial education is great. That's what I'm doing, but it helps people who are going to be better off in any case. And rapid change in the financial system depreciates basic financial knowledge. So as in many other areas of life, you can't educate once and then forget it. You have to have some form of continuing education. Okay, so if people don't have a lot of education, what do? People often proceed intuitively, but in the financial context, human intuition fails. And this is what has been demonstrated by the behavioral finance literature over many years now. We're just trying to draw on that and summarize it. We talk about cognitive biases like anchoring, the failure to understand how exponential growth works, extrapolation from small samples, thinking that a small sample is representative when it isn't, relying on your own personal experience. Think of Ulrika Malmendier and Stefan Nagel's work. Base rate neglect, so not being a good Bayesian and neglecting base rates. These are all well-known biases that have real implications in personal finance. Now, in many areas of life, people proceed with what's called reinforcement learning. They just repeat what felt good last time. So if I go to a restaurant and I have a bad meal, I don't go back. If I have a good meal, I do go back. I don't need a lot of intellectual understanding. I just repeat what worked. The trouble is in personal finance, outcomes are delayed. You won't know that you didn't save enough for retirement until you're old and it's too late to save. So outcomes are delayed. They're also uncertain. There's randomness. And people tend to confuse luck and skill. So if they invest and they do well, they think they're skillful. Now, another way people learn is social learning from friends, family, older people, and so forth. But this also fails in this context because there are correlated shocks. So a large cross-section of experiences can still be misleading. If it's a housing boom and you talk to a lot of people, they'll all say, I bought my house and it went up. You should borrow all you can to buy the biggest house you can. Well, that's fine until house prices fall. It's also true that people don't talk honestly about money. They are very reluctant to admit their failures and tend to exaggerate their successes, and that distorts the transmission of information. This is a theme that David Hirschleifer has developed in his work. Beyond all these cognitive biases, there's also the preference issues, present bias, the work of my colleague David Leibson, the tendency to put more weight on the present than the future. It makes it hard to do the right thing, even if you know what that is. And people react to all of these difficulties, we claim, by not liking to think about personal finance, not liking to plan, not liking to shop, and making financial decisions intermittently when forced to do so, and very often emotionally. All right, so people really struggle with this. Now, the key point, though, is what that does to the financial system. So how does capitalism work when you have a lot of people who don't know what they're doing? That's the question. So we start by categorizing the mistakes that people make into four categories. There's misperceiving a benefit, not understanding a true benefit, or believing in a benefit that isn't there. Misperceiving costs, not seeing the hidden costs, what the Biden administration sometimes called junk fees. Failure to search, failure to shop around, just taking the first offer that you get. And finally, mismanaging products once they're purchased. For example, failing to refinance a mortgage when you should, or letting your insurance policy lapse once you bought it. So there are these four types of mistakes. Now, the first two have a very obvious and simple effect, which is capitalists supply the products that are demanded, not those that objectively serve their customers' interests. We make an analogy with unregulated medicine when, the market supplied what people wanted, but sometimes that was snake oil rather than actual healthy medicine. The failure to search creates a different problem, which is that financial firms have market power. They can charge markups and not lose all their business. People often choose financial products on the basis of brands and familiarity with a brand. But there's free entry into the financial system. So we get rent-seeking free entry, which raises costs. Think about in the US how many bank branches there are, which simply are a form of advertising, how many realtors there are trying to sell houses. So the costs of financial products go up both because there's this wasteful competition that raises everybody's costs and because there are markups. Beyond that, financial firms often like to make products complex and bundle different products together in a way that makes it even harder for people to shop and worsens this problem further. Finally, what about this product mismanagement? A big theme of the book and of a lot of the research that I've done over the years is that product mismanagement leads to cross subsidies. This is what my colleagues Xavier Gebex and David Leifson have called shrouded equilibrium. So here are some examples. Overdraft fees, exorbitant overdraft fees, say $35 an overdraft. That gives banks a lot of revenue. They offer some of that to customers up front by offering free checking accounts. That means the people like those of us in this seminar who don't overdraft their account have cheaper checking than we otherwise would. But that comes at the expense of the people who mess up and pay the overdraft fees. Similarly, credit card late payments subsidize card rewards. There's evidence in the US that Black and Hispanic mortgage borrowers pay higher rates because they refinance slowly. That extra revenue raises the prices of mortgage-backed securities, and some of that benefit is passed on to borrowers in the form of lower mortgage rates for everyone up front. Who benefits? Well, it's disproportionately white borrowers who do know how to refinance. Finally, life insurance lapses subsidize those who keep insurance in force. And once you become aware of this, I think it's important to be a little outraged. These are transfers systematically from poorer, less educated people to richer, better educated people. And we should not be happy about this. Final point in the chapter, people often are naive about conflicts of interest. That means it's easy for financial professionals to take advantage because the counterparties, the clients, the customers are not wary. But then when people do figure it out, they become angry and mistrustful. And despite its importance in a modern economy, the financial industry is deeply unpopular. And we think this is a problem. It undermines faith in capitalism itself. Some people react to all of this by saying, forget the financial system. It's out to get me. I'm going to do something else. I'm going to keep my money under the mattress, or I'm going to just borrow from family and friends. Or maybe I'll turn to a money lender or a loan shark, particularly in emerging markets. Or maybe I'll go to crypto. We talk about that later in the book. We argue these alternatives are all worse. It's out of the frying pan into the fire. That's illustrated with the figure on the right here, which is talking about interest rates from the formal economy, that's the blue lines, or the informal economy, family, friends, money lenders, loan sharks, and that's the orange line. And this is showing the distribution of these rates. And what you see is that, yeah, there's a little bit of cheap borrowing you can get from friends and family, but then there's once you go into the moneylender loan shark world, you're talking really terrifying interest rates. Finally, we emphasize that society needs formal finance in order to allocate capital efficiently. The modern economy is built on formal finance, so it's vital to maintain the trust of the population in that system. Okay, well, that's part one, and I know we're 25 minutes in, so I'm going to go very quickly through part two, which is details. Just one slide per chapter. We've got 4 chapters covering different aspects of personal finance. So I'll go quickly through that and then talk about solutions. So chapter 4 is about managing the ups and downs, the short-term volatility of income. We highlight the problem that so many people have limited savings. That's illustrated in the figure at the right, which uses survey data from a number of different countries, showing the fraction of households who don't have 3 months of expenses available in liquid form. There's the challenge of earning safe interest on your emergency funds, as opposed to either taking risk or earning nothing. Of course, there's high costs for short-term borrowing if you have to get it when you're already in need. And then when people do get into debt, they often manage it poorly. They don't pay it off in the right way, or first of all, they might ignore the problem. They might pay off, following an inferior strategy. And once they get deep into distress, they may pay high fees to debt consolidators. They may not use bankruptcy as a escape valve in the right way. So that's chapter 4. Chapter 5 treats 2 topics in parallel, higher education and housing. Why are these parallel? Well, they're both large, lumpy investments that need to be financed and that have high returns. Of course, educational debt is unsecured debt, mortgages are secured debt. We highlight that fact, but we think nonetheless, from the personal side, these decisions have a lot in common. And we emphasize how complex it is to make these decisions and finance these investments in the right way. It's very tricky to understand the cost and return of higher education. Student loan repayment plans are vital. Mortgages are unbelievably complex. I've written a lot about this. It's not just about choosing the mortgage, it's also about how you refinance it once you've got it. So I won't go into detail there, but this is a favorite research topic of mine, and I think it's very important. Chapter 6 is called Living with Risk. And this chapter uses expected utility theory. Now, I say here on the slide, fools rush in where angels fear to tread, because that's the academic framework that we know and love, but it's hard to explain it to a general audience. But we try to do that in this chapter. And we use it to explain topics like the principle of participation. You should take some risk, even if you're very conservative, provided there's a risk premium. The Merton formula for the portfolio share in risky assets. The way in which diversification raises the Sharpe ratio. And how you should buy insurance. If insurance is marked up, you shouldn't fully insure, you should buy partial insurance, but how should you think about that? So we think this chapter might be useful, but undoubtedly it's a little more difficult than some of the rest of the book. And then we try to convey other vitally important ideas like efficient markets, the question of whether there's mean reversion in stock returns, drawing on the work I did years ago with Bob Schiller and other work since. And then, the concepts of adverse selection and moral hazard to understand insurance pricing. So it's an intellectually ambitious chapter, but we think it's useful. The figure at the right here is just showing participation rates in different assets. sorting households again along the wealth distribution. And the line to look at is the yellow dashed line called public equity, because it shows that there's a surprisingly low equity participation rate, even taking into account what's in 401ks and IRAs, and even among people who actually have quite a lot of assets. And so that's a problem we highlight. Final chapter in part 2 is called Securing Retirement, and we talk about the life cycle and how you save for retirement. The context being an aging world population that's shown in the top figure at the right, which is the evolving world population age pyramid. And you can see how it's growing, but it's flattening out, right? Meaning that there's more and more old people relative to young people. Of course, there's less family support for older people because people have fewer children and they less commonly live with them. There's the shift from defined benefit to defined contribution retirement plans. And finally, the problem, which was particularly in the 2010s, less so at this moment, of very low real interest rates. The challenges then are that people seem to not save enough on average. That's illustrated in the lower figure on the right, which shows the wealth income ratio in the US in different years as people age. And while this slopes up, of course, people are accumulating wealth for retirement. It doesn't slope up as much as normative models would require. At the same time, people often seem confused about their retirement prospects. Some people who actually are in a comfortable position are very worried, and other people who should be very worried are not. So we summarize the research on that. And then we talk about how you manage, living in retirement. The annuitization decision, people seem very reluctant to annuitize. That's known as the annuity puzzle in the academic literature. And then finally, the problem of people who are cash poor but house rich, who should try to release housing equity in order to consume it and support themselves in retirement, but struggle to do so. That's the problem of trapped housing equity. All right, well, with all of that done, that's parts 1 and 2. It all sounds very gloomy and we're complaining about everything, but what do we think we could do about it? What's the solution? How can we fix personal finance? So we have 3 chapters on that. Chapter 8 is about financial technology, which we think is very important, very promising, but not a solution in itself. Chapter 9 is called Shove. And Shove is intended as a contrast to Nudge, the famous book by Thaler and Sunstein. We argue that nudges are too weak to handle this problem. We need to be more aggressive. Public policy needs to be more aggressive. It needs to shove the system, not just nudge it. And then chapter 10 is called We Can Do Better. And this is where we lay out a positive vision for a better financial system. So I think I've got about 15 minutes still, so I'll try to give you this last very important part of the book in 15 minutes. All right, so technology then, the promise and the peril. Well, what's the promise? It's all driven by, lower fixed costs. So I mentioned earlier on that fixed costs mean that poorer people pay higher proportional fees on financial products. That's still true, but it's less true than it used to be because IT brings down fixed costs, and that by itself is very helpful. That then further makes it cheaper to customize financial products to meet different people's needs. And finally, technology can lower search costs. We have websites like bankrates.com. We have, mortgage websites. You can just go on your phone and search very easily for a wide range of financial products. So this is all great, but there are dangers as well. Financial products can be used to target weaknesses. So think of gamified stock trading, where, for a while, the Robin Hood app was showing confetti every time you made a trade on your phone, just little fun gaming things. We Another example that I like is the fact that the leading app in China that lists mutual funds on your smartphone lists them in order of their returns over the last year. So what comes up at the top is the fund that did the best in the last year. You just can't think of a better way to encourage performance chasing than that. There's also the worry about price discrimination using personal data, the concern that technology can enable financial product providers to identify who's more or less likely to search and offer very high prices to those people who are not going to search. There's the concern about doing an end run around regulation. Decentralized finance, the crypto finance system is largely an attempt to replicate formal financial institutions in a deregulated space. Or take another example, deposit insurance has an upper limit because it's not supposed to protect very large depositors, but technology makes it easy for large depositors to split their deposits at very low cost and divide them among many banks, getting deposit insurance on all the trenches at once. Finally, algorithmic discrimination in credit allocation is a big worry. Can the AI, will the AI lending officer simply replicate racial bias even without ever using racial data explicitly? That's a serious concern. So how can we realize the promise while controlling the peril? We have a number of ideas. We favor what we call regulatory sandboxes, which allow new products to be experimented with on a smaller scale before they're rolled out to the general population. We think that automation of simple processes is less dangerous than claiming to solve very complex optimization problems. It's important to monitor evidence that consumer psychology is being manipulated. Data privacy standards are important and may need to go beyond the consent model that exists now. And finally, it's important to help late adopters. So one of the dangers of a shift to a high-tech financial system is that some people, for example, seniors, may be left behind and may be unable to access financial services. So we need to help them out. We need to help them keep up. And then finally, I'm not going to take time on this, but the chapter contains an anti-crypto rant. We argue that there are many dangers to cryptocurrencies and that many of the users don't know what they're getting into, basically. So I won't spend more time on that, but it's in this chapter. All right, so chapter 9, what role can government play? We do start by emphasizing that it's important for government to look after the basics and do the things that only government can do. So we talk about financial infrastructure, things like digital IDs, the payment system, electronic ownership registries, and so forth. This is really important. There are countries like Estonia that are famously good at this. The US actually is not in the vanguard at all and needs to catch up. And then we talk about education. I've touched on this already. We think financial education is very worthwhile, but can only be a partial solution. The next thing government can do is help channel the flow of information. So disclosures, this is the favorite remedy of the first thing that one always thinks of with these sorts of problems, because it's not very costly and it doesn't impose restrictions on anybody. We argue that the design of disclosures is key. To give you two examples, in the US and most other countries, the focus is on disclosing APR, a standardized annual percentage rate on a credit product. But actually, people find it hard to think in those terms without significant financial education. So we think that APR should be accompanied by a thoughtful disclosure of dollar costs of credit access in various standardized scenarios. Here's a second issue, college cost calculators. These have to be available in the US by law, but they're typically very complicated. You have to enter a lot of information from your tax return to even get a rough estimate of college cost, and many people are just daunted by that. So there's a lot of value to having something much simpler, more approximate, but much easier to use. We also think that quality control of information is a government function. So the figure on the right shows the nature of complaints by US households, US consumers to the Consumer Financial Protection Bureau through 2023. This complaints database, I think, is one of the most valuable services provided by the CFPB. Of course, this has all been shut down now by the current administration. But what you see in the figure is that credit reporting, the light blue, is by far the dominant source of complaints. And so quality control in credit reporting is another important issue. All right, well, what about nudges? So we have a section critiquing the nudge literature, showing that there's really two types of nudges. You can make a suggestion or you can impose a default. Suggestions are very often ineffective, and we talk about the Card Act suggestion that you should pay off your credit card in 3 years. Make payments sufficient to pay off your debt in 3 years. That doesn't seem to have done very much, actually. And there's other evidence along the same lines. Defaults work better, but there's a recent literature that is revisionist, if you like, that offsets the early enthusiasm for nudges by showing that weak defaults can have perverse effects while strong defaults trigger opt-outs. And importantly, default effects wear off over time. And often the financial industry itself does counter-nudging, which undoes the benefit of the nudge that you started with. So we conclude that nudges may be worth trying, but in general, this medicine is too weak. And then we say, let's do something stronger, let's shove. We think there needs to be coordinated regulation of consumer finance along the lines of the CFPB in the US or the Financial Conduct Authority in the UK. And that regulators actually need to be willing to name and shame, meaning naming financial products and markets that are not functioning well and calling them out. And then we think the regulators need tools to change prices, taxes, subsidies, price caps, tools to change costs to providers, for example, by offering safe harbor from litigation, and tools to regulate product access. Well, how should they use these tools? 4 themes are fight biases with biases, promote products like prize-linked savings that exploit the bias in favor of gambling to offset the bias against saving. Curb market power by requiring standardized product offers and regulating the units in which prices are quoted to promote competition. Clamp down on conflicts of interest, for example, by imposing fiduciary duty on financial advisors. And promoting the automation of financial decisions. We live in an era where engineers are putting on the roads self-driving cars. I've ridden in a self-driving Waymo taxi in San Francisco. Why don't we design self-driving financial products, self-refinancing mortgages, better target date funds that rebalance automatically in a more sophisticated way? But we argue it's also important not to go too far. And there are 2 types of regulation that we think are in the wrong direction. One is trying to impose fiduciary duty on the whole financial sector, kind of blanket, be good and look after your customers obligation. This is really what the FCA has tried to do with its consumer duty in the UK. And we think this is dangerous because it's likely to choke off innovation and raise costs. And fiduciary duty for financial advisors, yes, but not for all the financial services providers that are counterparties to households. We also think that it's not a good idea for the government to get into the direct provision of financial services because finance is a very high-tech business and big government IT projects tend to go wrong. We've got a whole list of examples here from the US and the UK of how these things go wrong when government tries to do big IT infrastructure projects. Okay, So, last chapter, and I know I'm almost out of time. Just as I get to the punchline, you may need to read the book, buy the book to get the punchline. But this chapter offers a positive vision of a better personal finance system. And the basic idea is we think that people need access to what we call a starter kit for personal finance, an analogy with the basic equipment you need to play a sport. You don't go out on the field, depending on what field it is, without cleats, pads, helmets, bats, etc. And these need to be on offer and standardized and easy to shop for. These products need to be simple, cheap, safe, and easy. I know that sounds a little bit like four of Disney's seven dwarfs, but we think they're important principles, and we try to flesh out in the chapter how that works in detail. In each financial product category, we think that financial companies that are active in that company should be required to offer starter kit products. They can offer other products, that's fine, but they must offer the starter kit products. And these products must have standardized designs with price structures that facilitate comparison shopping and that are easy to manage after purchase. We're not going to generally regulate the prices of these products because we think they'll be so easy to shop for that competition will do the job. Let me make the analogy with going into a pharmacy and buying, let's say, ibuprofen for a headache. You can buy the brand name, but right next to the brand name, the Advil on the shelf, is the generic ibuprofen. You can easily see the bottles are the same, the dosage is the same, the active ingredients are the same, and you can easily shop. And we think personal finance needs to be made more like that. In some categories, we think it's appropriate to go further and actually require households to buy one of these products. So that's mandatory to choose. We don't think that's always necessary, but sometimes it is. So I'm going to be super quick now. We basically go through the financial system following the same order of topics as in part 2 and talking about what these products are. So transactions accounts, savings accounts, and lines of credit for managing short-term fluctuations. And I'm really skipping fast here. So starter kit products for making large investments, educational loans with income contingent repayment, simple mortgages. If they're adjustable rate, they shouldn't have teaser rates. If they're fixed rate, they shouldn't have points. And some other nice design features that we talk about. Products for living with risk, index funds. This is a rare example where we think fee caps are appropriate because index funds should not be high fee. We're okay with simple structured products, although not complicated ones. Short-term insurance, it's vital to have transparency about claims and payouts. High deductible policies should be emphasized because they're cheaper. And then long-term insurance products. What about retirement? We think a single retirement account with automatic enrollment at the date of first employment is the way to generalize, to broaden access in the US. We talk about target date funds, which are common in the US, not so common elsewhere, but we feel are very good products, although they can be made more sophisticated. And then we talk about products for retirement consumption, deferred payout annuities, and standardized reverse mortgages. So finishing up then, people can go beyond the starter kit. We're not trying to nationalize the financial system. We're not trying to choke off financial innovation. We think people should go beyond the starter kit on the basis of modest wealth accumulation in the starter kit and demonstrated financial knowledge. So in some cases, we want to lower the barriers. So, in the US at the moment, you have to be an accredited investor, which means rich or high income, to access a number of financial products. We would rather have financial education barriers rather than high income and wealth barriers. And to conclude, is this all pie in the sky? What's really realistic? Obviously, elections matter. In the US at present, none of this is likely to happen very fast. But different countries are different. And so some of these ideas, it may be a good time to work on them in some countries. We are very aware that Countries differ in their economic fundamentals, their financial system structure, and their cultural attitudes. So we don't believe that one system fits all. We're not trying to impose a common financial system on the entire world. But we do think the ideas in this book are important and applicable in many, many places. The problems in personal finance are serious enough to undermine support for capitalism itself. And we think that's very dangerous. And it's just dangerous to neglect these problems. So what we're trying to do is to raise awareness of these problems, which show up in places around the world, and the benefits of looking around the world to find best practices and then carrying them across borders, rather than simply taking for granted the financial system that each country has. So let me stop there and see what questions and comments everybody has.
Thank you very much for the presentation, and above all, to be in the 45 minutes. I know that is a tremendous task in a very comprehensive book to deliver just in 45 minutes. So in your book, you look at everything, you know, from short-term saving and borrowing to loans for education and housing, financial products for retirement, very important and relevant nowadays, insurance, etc. And you argue, and your co-author, that the system is organized or fixed to benefit those, and this is part of the questions that comes today, who are wealthy and more educated, while encouraging financial mistakes by those who aren't, making it difficult for the average consumer or the ordinary people to make sound financial decisions. Do you think, you addressed that in your presentation, but I would like to go a little bit further. Do you think that financial literacy in primary and secondary schools and the creation of financial literacy programs for adults and seniors, like in European Union, has developed concrete policies or programs and learning materials, will help to mitigate this problem? Is there a role or importance to regulators, and also the relationship between fintech and financial literacy? Do you think that there is a role to fintech to avoid this issue in terms of the healthy and the average or ordinary people?
These are great questions. And look, let me say, first of all, yes, financial education can help. So you know, one of my side activities, I've recently joined the board of the Council on Economic Education, which is a US nonprofit that promotes economics and particularly personal finance education in high schools, K through 12 schools throughout the United States. I'm also a huge fan of the work of Anna Maria Lusardi, and she's, you know, really promoted financial literacy both on the research side, but very importantly in the policy side around the world. And you know, I would say that Anna Maria is doing God's work. Now, having said that, I really don't think it's a complete solution. I think this is a huge problem, and it needs to be approached from both ends. We need to help people know more and do better, right? That's financial education. But we also need to make the task easier. Which is coming at it from the other end. And if we only do the financial education but don't touch the incentives of the system, the danger is that people will still have incentives to design complicated new things, change it up, and exploit biases despite the fact that people were educated. Now, I'm also a fan of adult financial education, and I think there's a role, for example, for employers to offer this to employees. But you know, those of us who work for big organizations and have attended mandatory employee trainings, we sort of all know how that goes, right? You go online, you click through, you maybe even you do the little test, but your heart is not in it necessarily. So I don't think we want to exaggerate the effectiveness of these things. Yes, we should try them, but I don't think it's realistic to believe that these are going to fix all the problems.
Mm-hmm. Thank
And
you.
then fintech, of course, fintech can be used for good. It can be used to contribute to financial education, but it can also be used for bad. In the book, we quote a character from an Isaac Asimov science fiction novel who says it's a poor atom blaster that won't face both ways. You know, so we have an atom blaster, but are we going to use it the right way or the wrong way? Again, I think regulation plays a role.
Thank you. Thank you very much. I'll follow the order of arrival of the questions, and there's the one that is asked or highlighted is innovative personal finance bonds issue in Brazil in 2023. I don't know if you are aware about it. I'm not, to be honest. That cater to the cash flows of retirement and funding a child's education, and are based on the existing financial literacy of the general public. So basically, do you think
That sounds very interesting and innovative, and it actually illustrates the fact, and this is a point we make in the book, that some of the most promising innovations actually are coming out of countries that are poorer than the traditional wealthy countries. Brazil is a very good example. Brazil, for example, is a leader in electronic payments. The central bank providing digital payments technology that ordinary people can use. Brazil is a leader there. But we talk about how you should look around the world, and sometimes the countries that are not encumbered by legacy systems with all the vested interests that build up around those legacy systems can do inspiring new things, and we ought to learn from that. So I don't know the particular Brazilian case that's being brought up, but I think it illustrates a general theme.
Yeah, absolutely, absolutely. Now we have a question from Mohammed Levy, if I pronounce correctly. What is the primary reason, if there is any, that's my comment, oops, it moved. Intuition fails in personal finance for decision making, and why do some well-educated people still favor intuition over rational analysis in financial choices? If there is a reason or a primary reason to this.
Oh boy, it's a really deep question, and I'm not sure that I have much to offer beyond the behavioral finance literature. I mean, I feel I'm a consumer and applier of that literature. Rather, I am not myself a personal finance theorist. But I think a general theme that I get from that literature is that the brain has evolved to handle familiar situations. So our cognition doesn't solve every new problem completely from scratch, because that's very costly. We don't have the processing power to do that, or at least to do it in quickly enough to be useful. So what we've evolved to do is, when we faced with a new problem, we relate it to problems we're already familiar with, and then we make adjustments to the familiar solution based on the way this particular problem looks. And that's, from an evolutionary point of view, that's a pretty good way of proceeding in life, at least in traditional life, that we evolved to survive. The difficulty is that can go wrong when the context is unfamiliar. So anchoring is an example of that. We tend to think about numbers in relation to reference point numbers that we're used to. And if we're confronted with a very different number, that we can get that wrong, because we're still using the default in the brain that we had set up previously. So that's just one example. or take the fact that we more often see linear processes. So we naturally in our brain think about things linearly. But then if we are faced with an exponential growth process, that linear approximation is going to be very poor. And then the theme of the book is there are in the financial world, we face counterparties, sophisticated institutions that can design products to exploit these biases.
Absolutely.
So,
Absolutely.
I mean, just to give one very, very simple example, the reference point idea. Why is it that when you go to buy a car, just as you've signed the paperwork, you're about to drive away in your lovely new car, they say, "Oh, wouldn't you like this extended warranty?" And it's only, it's only $500. And these floor mats, these will protect your beautiful car, and they're only $300. Now, normally you would really hesitate to spend $500 here, $300 there. But this is in the context of a purchase you've just made of a car that's worth, let's say, $30,000. So the reference point temporarily in your mind is $30,000, and the insurance and the
Right.
floor mats, they seem cheap. So people say, sure, and they sign up, right? So that's exploitation of the reference point effect. And this goes on in more subtle ways in the whole financial industry, and that's the problem.
Yeah, absolutely. Thank you very much. I will jump over some questions because some of them are related to financial education, financial literacy that we already discussed. And I'll go to one very precisely to the US, which is referred to regarding the financial corruption part of your book. Do you think US households face the same difficulty investing in health insurance as they do in life insurance? Or if there is some different difficulties?
That's a great question about health insurance. I should say that health insurance is a topic that we largely punted on in the book. We left it to one side, and that's because it's a vast area. Health is, health economics is a whole field of itself. And in addition, health insurance, the arrangements for health provision are so different across countries that we didn't think our global approach would work in the health context. Having said that, to answer the question in the US, we think there are problems, and I'll mention two. One is the tendency of people to people have this tendency to prefer low deductible insurance that covers all their costs. Even though that tends to be very expensive, it's expensive because it raises the administrative costs of the insurance company and also because it encourages overconsumption of routine health services. So low deductible insurance tends to be really expensive, but people don't do the calculation correctly. And to see that, there's research that shows that it's astonishingly common for people to choose health insurance plans that are actually dominated by other plans, in the sense that there is no scenario in which you'll do better with the plan you choose than the plan you reject. That's just mind-boggling. People are, literally throwing away money.
Yeah,
Now,
absolutely.
of course, it's also, I think, scandalous that large employers even offer dominated plans, right? There should be a menu of choices, but the idea that one of the items on the menu is dominated by another suggests that something went wrong with the menu design. So, it's a very important area, and I sort of regret we couldn't do more on it in the book, but it isn't really much in the book at all.
For the next one, probably.
Okay.
Can we take a last question? We already passed the time. We don't want you to get late to your class with the 350 students waiting. But it's a question that is different from all the others before and tackle a different area, which is private equity and cryptos. Danling Jiang asked, alternatives like private equity and cryptos are coming to retirement accounts. Will this easier access make wealth accumulation more or less equal? the easy access to crypto that will make his wealth accumulation more equal or less. So
Yeah,
what
wow,
is your take on this?
that's another great question. I think private equity and crypto are a little bit different and raise different issues. Private equity, it's a big component of wealth. There are real assets there, and the standard argument for holding the aggregate portfolio of all wealth that all finance economists know and love says that you should be holding some private equity. The trouble is that the fund structure of private equity is tricky for individuals to manage. For one reason, the imperfect marking to market smooths valuations, it hides risk. There's a danger that people will overinvest in private equity because they think it's safer than it really is. In addition, private equity managers are unlikely to offer the best stuff to the retail funds. So you're likely to get an inferior selection, if you like, adverse selection in the private firms that you end up owning. And I think, in fact, those two problems outweigh the benefits in private equity. So I'm skeptical of private equity in retirement plans. On crypto, I think it's a different problem. It's not so much fees. My concern is just that crypto is extremely speculative. It's not at all clear what the basis of the valuation is. And so the danger is that people's return chasing tendencies will lead them to allocate a lot of money to crypto, and then there'll be a crash and they'll lose it all. So I'm a crypto skeptic.
Yeah.
Even though it is true now that crypto is becoming a meaningful portion of world wealth. And so again, if you think you should invest in the wealth portfolio, then again, there's a case for having access to crypto. But I just think my bet would be that both private equity and crypto in the end are going to worsen wealth inequality rather than reduce it.
Thank you very much. Before I pass to Michelle to end the session, thank you very much for the extra time. I think that we need a follow-up session just with questions, no presentation, because we still have 40 questions that has been asked today, so it was overwhelming. We'll share all the questions with you, of course, by the end. Apologies for the attendees that I was not able to pass them, but that is the restriction of time. Thank you very much again to be with us and to share with us that stunning book that I believe that everyone is looking forward to read.
Yeah.
Thank you very much. Thank you.
Thank you very much. So again, on behalf of FMA and FEBAR, and thanks so much again for your very thoughtful seminar today. For those who are still in the room, almost 200 of you, 7 past the hour here. The link for the book is in the chat. Again, we're sorry for the 37 unanswered questions, but this is just how thought-provoking the seminar was. We will share all questions with Professor Campbell after this. But again, if you're interested in the book, it comes out in October, I believe 21st. The link is in the chat. Please join us next week for a seminar with Dr. Gordon Phillips of Dartmouth. Until then, have a good day, and thank you again, Professor Campbell.